You're watching Silver News Daily. Subscribe for more. Imagine seeing silver prices skyrocket to $3,000 by the end of the year. It sounds unbelievable, right? But financial expert Michael Pento believes this could be our reality. In this video, we'll break down the compelling factors that support this bold prediction. From market trends to geopolitical tensions and economic policies, stay tuned to uncover why silver could soar like never before. And don't forget to subscribe for more eye-opening financial insights.
Isn't that wonderful? That's the truth. Then again, that's why I come on shows like yours, because you get the truth. The truth is that when you were able to untie your dollar, or whatever nation, Zimbabwe, Argentina, Hungary, Germany, whatever nation pursued that path, and they've done, various times throughout history, of just saying, hey, let's just print money to keep interest rates from rising and buy our debt. And that always gets out of control, and that always leads to hyperinflation. So you say, well, and some people say, well, that, Mr. Pento, that could never happen in the United States. Why not? Do the laws of economics not apply to the United States of America? Oh, because we're the world's reserve currency, but we're losing that. But Rome had the world's reserve currency, the Roman Empire, and that caused that still didn't prevent inflation from going to 1,000% per annum in Rome. It can happen. If it happened in Rome, the only world power there was in the known world, it could happen to the United States. Absolutely. Remember this, that it wasn't too long ago when I first got into business, about 33 years ago, where the idea of having a deficit that was $1 trillion would be completely anathema. Central bankers were bragging about how we would never have $1 trillion in deficit. We would never monetize debt. Well, you've monetized $4.5 to $5 trillion just since COVID. Monetized, you just printed it. The central bank's balance sheet went from $700 billion in the wake of the financial crisis, prior to the financial crisis, to over $9 trillion. And now they're in a rush to stop quantitative tightening. Why? You happy? Are you happy with inflation rising at 3.5? Now, I did go to school and did take a lot of math classes. So is 3.5% higher than 2? It's a lot higher than 2, right? So why are we looking for reasons to cut interest rates? And why are we looking for a way to get out of quantitative tightening when inflation is way above your target? And like I said before, prices need to fall, not go up more slowly from an unaffordable level.
Currently, silver is experiencing a strong bullish trend. Recent data shows silver climbing 0.59%, trading at $30.30, and recovering from near weekly lows. This upward movement is supported by softer than expected U.S. durable goods data and improved consumer sentiment. Technical analysis indicates that the Relative Strength Index, RSI, remains bullish, signaling strong buyer momentum even after exiting overbought conditions. This suggests that silver has the potential to push higher, with key resistance levels at $30.97, $31.50, and the year-to-date high of $32.51. The consistent performance above the psychological level of $30 paves the way for further gains.
Significantly, trenchantly, to avoid the next recession. The problem is they can't do it. And the reason why they can't do it, they can tinker around the edges. They can lower rates by, 25, 50 basis points. But here's the issue. Here's the reason why they can't. Home prices are up 50% in the last 4 years. 50%. Taxes and insurance costs have skyrocketed. Dylan, home ownership is unaffordable. And then you take food prices, they're up 37% according to the Wall Street Journal, 37% in the last couple of years. So when you have a consumer and corporations that are under this much debt and this much an onerous condition of refinancing the debt, what really needs to happen is for prices to fall. But what's happening is they're going up at a slower rate. So again, let me reiterate. if home prices are up 50%, and they are, according to Case-Shiller, in the last 4 years, I pulled that data up this morning, so it's fresh data. 50%, 47 change to be exact. Home prices need to fall, not go up more slowly. And when your trip to the grocery store costs almost 40% more than it did a few years ago, prices need to fall, not go up more slowly. But the Fed is out there saying, you know what, we have a victory. So they're not going up 9% anymore. They're going up 3.5% year-over-year change. That to the Fed is a victory. And why is the Fed interested in declaring that, obfuscating that as a victory? Because they understand if they don't get interest rates down quickly, we're going to have a recession, and it's going to be a sharp one. I don't think they can until the credit markets freeze and the money markets freeze. And in that case, we're going to have, and here's where I'll wrap it all up, I think we're going to have another bout of disinflation and perhaps even head into a truncated period of deflation as just everything just shuts down.
Now let's dive deeper into one of the most critical factors driving the bullish sentiment for silver, the supply-demand imbalance. This imbalance is a key indicator of why silver prices are poised for a significant surge. First, let's talk about the supply side. The global silver market is experiencing a fourth consecutive annual deficit. This means that the demand for silver has consistently outpaced its supply for 4 years in a row. One of the primary reasons for this deficit is the reduction in mining output. Many silver mines have faced operational challenges, regulatory hurdles, and higher production costs, leading to lower overall output. On the other hand, demand for silver is soaring, especially in industrial applications. Silver is not just a precious metal, it's also an essential industrial commodity. One of the most significant areas of growth is in solar photovoltaics. The push for renewable energy has led to a substantial increase in the production of solar panels, which require a significant amount of silver. According to recent reports, demand from the solar sector alone is expected to reach record levels, further straining the already tight supply. But it's not just solar energy driving demand. Silver is also used in the electronics industry, medical devices, and even in the automotive sector, particularly with the rise of electric vehicles. These applications are expanding rapidly, and with the global push towards greener technologies, the demand for silver in these sectors is only expected to grow. Moreover, silver's role as a hedge against economic uncertainty cannot be overlooked. In times of financial instability, investors flock to precious metals like silver and gold. The current global economic environment, marked by inflationary pressures and geopolitical tensions, has made silver an attractive investment option. This safe haven demand further exacerbates the supply-demand imbalance. Another crucial point to consider is silver's undervaluation compared to gold. Historically, the gold-to-silver ratio, which indicates how many ounces of silver it takes to buy 1 ounce of gold, has been a key metric for precious metal investors. This ratio has recently been at historically high levels, suggesting that silver is significantly undervalued relative to gold. As investors look to capitalize on this discrepancy, increased buying pressure on silver could lead to a substantial price increase. All these factors combined create a perfect storm for silver prices. The consistent supply deficits, rising industrial demand, safe haven buying, and historical undervaluation are powerful forces that could drive silver prices to unprecedented levels. So with the supply dwindling and demand skyrocketing, it's clear why experts like Michael Pento are predicting a massive surge in silver prices. Stay tuned, because in the next segment, we'll explore how silver's performance compares to gold and why this could signal a major shift in the precious metals market.
And then by doing that, they have a tool. It's a fiat currency. It's not backed by anything. It's unfettered with the price of gold or tied to it in any way or any commodity. It's not tied to GDP growth. It's not tied to productivity growth. It's not tied to population or labor force growth. It's tied to one thing. What do these 12 apostles, the 12 voting members of the Federal Open Market Committee, what do they think? That's what it's tied to. And so what they say is their calculation is, well, banks will go under and we'll have a depression if we let asset prices fall to where they should be, where they can be supported by the free market. Can't have that. So we're going to pretend that we care about the poorest among you. But if they did, then wouldn't they just look at the Wall Street? This is not my numbers, the Wall Street Journal, and they undercounted it, a 37% increase in food prices. Nobody's income. Nobody. A very, very small percentage of the U.S. population has had their incomes increase 37% over the past few years. And as a matter of fact, if you look at the BLS data from the non-farm payroll report, a lot of people are losing we're creating part-time jobs and losing full-time jobs with benefits and higher wages. So there's a cogent argument to be made that, your incomes are flat. They're skewed to the wages and incomes are skewed to the higher end. The top quintile is doing fine. The lower four are getting wiped out. 78% of Americans are living paycheck to paycheck. I think some 60% of them don't have $1,000 in the bank, and that's a success. This never would be remotely possible if we didn't have 100% fiat currency. And the Fed didn't think they had a tool. I said, wait a second, why do we have to live in reality? We could just print money. And every recession and every bear market can be monetized away with our tool.
Next, let's compare silver's performance to gold and understand why silver might be set to outperform its more illustrious counterpart. Historically, gold has always been the go-to precious metal for investors during times of economic uncertainty. It's considered a safe haven asset, a store of value, and a hedge against inflation. This status has allowed gold to reach record highs while silver has often lagged behind. However, the dynamics are starting to shift. While gold continues to perform well, silver's broader industrial applications and the current market conditions are positioning it for potentially greater gains. Silver has always been known as poor man's gold, but this label belies its significant industrial importance. One of the critical differences between gold and silver is their industrial utility. Gold is primarily used in jewelry, electronics, and as an investment. In contrast, silver has a much broader range of industrial uses. Apart from its use in jewelry and investment, silver is vital in manufacturing solar panels, electrical contacts, and various types of industrial equipment. This makes silver more sensitive to industrial demand and economic growth. Recent data shows a burgeoning demand for silver in several high-tech industries. For instance, the automotive industry, especially the production of electric vehicles, EVs, heavily relies on silver for its electrical components. As the world transitions to greener technologies, the demand for EVs is set to explode, subsequently increasing the demand for silver. Moreover, the ongoing global push for renewable energy has led to a significant rise in the production of solar panels. Silver is a critical component in photovoltaic cells, which are used in solar panels. As countries strive to meet their renewable energy targets, the demand for solar panels, and hence silver, will continue to grow. Another point of interest is the gold-to-silver ratio, which we touched on earlier. This ratio is currently at historically high levels, indicating that silver is undervalued compared to gold. Traditionally, when this ratio is high, it often leads to a correction where silver prices increase at a faster rate than gold. Investors looking to take advantage of this correction are likely to buy more silver, driving its price up further. Additionally, the supply constraints that silver faces are not as pronounced in the gold market. While gold mining operations have also faced challenges, they have not seen the same level of deficit as silver. The tighter supply conditions in the silver market, combined with increasing demand, create a unique opportunity for silver to outpace gold in the coming months. Investor sentiment is also shifting. As gold prices soar to record highs, some investors are turning to silver as a more affordable alternative with significant upside potential. This shift in sentiment is further fueled by the economic policies and geopolitical uncertainties that favor investments in precious metals. In conclusion, while gold has historically outperformed silver, the current market conditions suggest a potential reversal. Silver's broader industrial applications, combined with its undervaluation relative to gold, and the supply-demand dynamics, position it for a major breakout. Stay tuned, because next, we will delve into how geopolitical tensions are influencing silver prices and what this means for future market trends.
In the economy, that's a very salient risk. So how am I positioning my clients? I'm getting ready for possibly moving in that direction, which would be sectors 2 and 1 of my investment spectrum. And then I see intractable stagflation after that, because the Fed's going to say, listen, we have to ignore the fact that home prices were up 50%. We can't let them drop even maybe 15, 20% without bankrupting every bank on the planet and every pension plan. And the consumer would, the wealth effect would go into reverse in a huge way if stock prices drop by 40%, which is where they need to drop just to bring them back into historical norms. So they can't let that happen. So then we're going to just go back to ZERP and QE and helicopter money. And if that happens, you're going to see intractable stagflation like we've never before seen. So a lot depends on what the government does. I think, and I even heard Janet Yellen today say that, listen, we have to get rates down. The Treasury cannot afford to refinance its debt. Don't forget the 10-year note was 33 basis points right after COVID. Now it's 4.6%. The two-year note's almost 5. It was 4.85%, 4.9. It was 5% a few days ago. They just can, and they're issuing a lot of T-bills, right? A lot of this debt is being issued at the short end. Now, paying next to zero is great, but paying 5% when your debt to GDP is 123%, you have, was it $38 trillion of debt outstanding and rising rapidly? When your annual deficits are $2 trillion, when the interest on the debt is $1 trillion, it's just not a tenable position. So what I'm saying is the government understands that to keep the ruse alive, it's a lot easier just to pursue inflation than to lie about it. They do. They use mendacity. And why wouldn't, any sentient central banker would say, listen, home prices are too high. They're not affordable. There's no market for them anymore. They have to come back down. But they don't care about that. They care about banks. So they're going to flood the system with liquidity. And I see a very, very long and dangerous and unsuccessful battle with stagflation.
Geopolitical tensions have always had a significant impact on precious metal prices, and silver is no exception. Recently, escalating conflicts in the Middle East, particularly the tensions between Israel and Hamas, have played a crucial role in driving silver prices higher. Let's explore how these geopolitical factors are influencing the market and what this means for the future. First, consider the immediate effects of geopolitical instability. When conflicts arise, uncertainty spreads across global markets. Investors seek safe haven assets to protect their wealth from the volatility and risk associated with such events. Silver, like gold, is one of these safe haven assets. The increased demand for silver during times of geopolitical turmoil often leads to price spikes. For instance, recent Israeli airstrikes in Rafah and the subsequent rocket attacks claimed by Hamas have heightened tensions in the region. These events have not only caused significant loss of life and property, but also rattled financial markets. Investors, concerned about the potential for a broader conflict and its impact on the global economy, have turned to silver as a safe investment. This influx of investment drives up the price of silver. Moreover, geopolitical tensions can disrupt supply chains, particularly for industrial metals like silver. The Middle East is a critical region for the global economy, and any instability there can lead to broader supply chain disruptions. These disruptions can affect the mining, production, and transportation of silver, further constraining supply and pushing prices higher. The impact of geopolitical events is not limited to the Middle East. Tensions between major global powers, such as the United States, China, and Russia, also play a significant role. Trade wars, sanctions, and diplomatic standoffs create an environment of uncertainty. For example, the ongoing trade disputes between the U.S. and China have led to economic uncertainties that make safe haven assets more attractive. As these tensions escalate, the demand for silver as a hedge against economic instability grows. Additionally, geopolitical factors often influence government policies and economic strategies. For instance, countries involved in conflicts may increase their defense spending, leading to higher national debts and inflationary pressures. This economic strain can weaken currencies and make precious metals like silver more appealing as a store of value. It's also important to consider the broader implications of geopolitical events on investor sentiment. When geopolitical tensions rise, the perception of risk in the financial markets increases. Investors tend to move away from riskier assets, such as stocks, and towards more stable investments, such as precious metals. This shift in sentiment can have a lasting impact on silver prices. The current geopolitical landscape is marked by several hotspots of conflict and tension. Beyond the Middle East, issues like the Russia-Ukraine conflict, North Korea's nuclear ambitions, and tensions in the South China Sea all contribute to a global environment of uncertainty. Each of these situations has the potential to disrupt markets and drive demand for safe haven assets like silver. In summary, geopolitical tensions are a significant driver of silver prices. The current global landscape, with its numerous conflicts and uncertainties, creates a strong case for rising silver prices as investors seek safety and stability. Next, we will analyze how U.S. economic data and Federal Reserve policies impact silver prices and what this means for future market movements.
I don't tell the market what to do. So I believe since we have a huge problem now, let's just back up a second and allow me to elaborate for a second. So we were headed in this condition anyway, insolvency, and we were headed in that direction before COVID, but COVID exacerbated and expedited that condition. And now you see like 40% of the Russell 2000 is unprofitable. Corporate debt is $13.7 trillion. That's up 100% since 2007. Corporate defaults are soaring. They're up 80% since 2023. There's $1.3 trillion in credit card debt. Now, I want to just point out two other markets to you. So CLOs, collateralized loan obligations. So those are loans to businesses who really can't get money from a bank. That was $300 billion in 2008. It's $1.4 trillion today. That's a 366% increase. Then you have something called private credit. That's loans to businesses who can't get a loan from a bank or issue corporate debt. That was basically it wasn't even a market prior to the global financial crisis. It was $100 billion outstanding in private credit. Now it's up 1,600% to $1.7 trillion. And that's those two things. So you have three things, corporate debt, CLOs, and private credit are multiple trillions of dollars that are recycling that debt at higher and higher rates. They locked it in for a while, but now as every day passes, they're having to issue this debt at higher and higher rates. So I asked you to give me a little leeway here, so I'm going to tie it all together. So I believe that the Fed has to cut rates dramatically in the next quarter or two.
Let's now examine how U.S. economic data and Federal Reserve policies impact silver prices and what this means for the future market movements. The interplay between economic indicators and monetary policy plays a crucial role in determining the trajectory of precious metals, including silver. Firstly, consider the impact of recent U.S. economic data. Strong economic performance, reflected in metrics like GDP growth, employment rates, and consumer spending, typically strengthens the U.S. dollar. However, the recent U.S. durable goods orders, which rose by 0.7% in April against the expected 0.8% decline, and the University of Michigan's Consumer Sentiment Index increasing to 69.1 in May, have presented a mixed picture. These indicators suggest a resilient economy, but also reflect persistent inflationary pressures. Inflation is a key factor here. When inflation rates rise, the purchasing power of the dollar decreases, making precious metals like silver more attractive as a hedge against inflation. Despite the Federal Reserve's efforts to manage inflation through monetary policy, the sustained high inflation rates continue to drive investors towards silver. The one-year inflation expectation has edged up to 3.3%, while the five-year expectation dipped slightly to 3%, indicating ongoing concerns about long-term inflation. The Federal Reserve's monetary policy also plays a pivotal role. Recently, hawkish remarks from Fed officials and robust U.S. economic data have limited expectations for significant interest rate cuts. Higher interest rates generally strengthen the U.S. dollar, making dollar-denominated assets like silver less attractive to investors. However, the anticipation that the Fed might only implement one rate cut by the end of the year has tempered the dollar's strength, providing some support to silver prices. Additionally, the Fed's stance on quantitative easing, QE, and its balance sheet policies influence market sentiment. In the past, aggressive QE measures have led to increased liquidity in the market, which often finds its way into commodities like silver. With the Fed now tapering QE and considering quantitative tightening, the reduced liquidity can put downward pressure on silver prices in the short term. However, if economic conditions worsen and the Fed resumes QE to support the economy, silver prices could see a significant boost. The interplay between U.S. economic performance and Federal Reserve policies also affects investor strategies. For instance, during periods of high inflation and low interest rates, silver becomes a more attractive investment. Investors looking to protect their wealth from inflation and potential currency devaluation are likely to increase their holdings in silver. Conversely, during periods of strong economic growth and higher interest rates, the appeal of silver might diminish as investors seek higher returns in equities and other assets. Furthermore, the US dollar's performance against other major currencies, influenced by both domestic economic policies and global economic conditions, affects silver prices. A weaker dollar makes silver cheaper for investors holding other currencies, thereby boosting demand and prices. Recent trends have shown the dollar strengthening due to higher interest rates, but any signs of economic slowdown or dovish shifts in Fed policy could weaken the dollar and support higher silver prices. In conclusion, U.S. economic data and Federal Reserve policies significantly impact silver prices. The current landscape of mixed economic indicators, inflationary pressures, and cautious Fed policies creates a complex but favorable environment for silver. As we continue, we will delve into broader global economic trends, such as inflation and debt levels, and how these macroeconomic factors contribute to a bullish outlook for silver.
I just mentioned is that our future then, where inflation is so high and the debt levels are so high. I mean, Japan is the highest debtor nation of any developed world as a percentage of GDP. There's well over a quadrillion yen in debt outstanding. It's an insolvent nation. And the only buyer is the Japanese central bank, the BOJ. And that's where I think we're headed. So it's going to be a perpetual condition of stagflation, no growth, a zombified economy, and very high inflation.
In that kind of an environment, if that paints a picture of where they have brought themselves and where we may be headed, what kind of positions as an active money manager do you look to protect your clients and preserve their purchasing power in a stagflationary environment?
Well, I don't remember the exact figure, but I think it was, I want to say 35% is what gold is up in yen terms this year, 35 or 40%. And gold is surging as it's priced in yen. So yes, the answer is stagflation when you have no growth and stubbornly high inflation. The answer is buy gold. That would be the first and foremost thing that I would buy.
Next, let's delve into broader global economic trends, such as inflation and debt levels, and understand how these macroeconomic factors contribute to a bullish outlook for silver. Inflation is a persistent global issue. In many economies, inflation rates have been rising steadily due to various factors such as supply chain disruptions, increased demand post-pandemic, and expansive monetary policies. High inflation erodes the purchasing power of currencies, prompting investors to seek assets that retain value. Silver, like gold, serves as a hedge against inflation, making it an attractive investment during periods of high inflation. The ongoing inflationary trends worldwide are thus driving demand for silver. In addition to inflation, rising global debt levels are a significant concern. Many countries have significantly increased their debt to manage the economic fallout from the COVID-19 pandemic. This has resulted in record-high debt levels relative to GDP in several major economies, including the United States. High debt levels often lead to concerns about the sustainability of economic policies and the potential for default, which can undermine confidence in fiat currencies and drive investors towards tangible assets like silver. Moreover, central banks around the world have been implementing policies to manage their debt burdens, often involving low interest rates and quantitative easing. While these policies can provide short-term economic support, they also contribute to long-term inflationary pressures. As central banks continue to navigate the delicate balance between stimulating growth and controlling inflation, the demand for inflation-hedging assets like silver is likely to remain strong. Another crucial factor is the global economic growth outlook. The world economy is facing numerous challenges, including geopolitical tensions, trade disputes, and the aftereffects of the pandemic. These challenges create uncertainty, which can lead to market volatility and increased demand for safe haven assets. Silver, with its dual role as an industrial commodity and a store of value, benefits from this uncertainty. In the industrial sector, silver's applications are expanding. Beyond its traditional uses in electronics and jewelry, silver is becoming increasingly important in green technologies. The push for renewable energy and the production of electric vehicles are driving significant demand for silver. Solar panels, which are a key component of renewable energy infrastructure, require substantial amounts of silver. As countries ramp up their efforts to meet climate goals, the demand for silver in this sector is expected to rise sharply. Additionally, the development of 5G technology and advancements in medical equipment also contribute to silver's industrial demand. These technologies require highly conductive materials, and silver is one of the best conductors available. The growing adoption of these technologies further strengthens the case for silver's long-term demand. The global economic environment also influences investor sentiment. As investors look for ways to diversify their portfolios and hedge against risks, precious metals like silver become more attractive. The current trend suggests that silver is not only a hedge against inflation, but also a strategic investment in the face of economic uncertainties and technological advancements. In summary, global inflation and debt levels, along with the broader economic growth outlook, create a strong foundation for a bullish silver market. The dual role of silver as both an industrial metal and a safe haven asset positions it uniquely to benefit from these macroeconomic trends. Stay tuned, as in the next segment, we will delve into Michael Pento's insights on potential disinflation or deflation and how this could further impact silver prices.
Because I happen to think that Japan is dumping gold and dollars to prop up their currency. They're dumping treasuries, which are dollar denominated, dumping those, buying the yen on the FX exchange. I think they're dumping gold too. And for days like today, where I saw the yen was very weak overnight, and then you say, well, why is gold down today? Interest rates are down and the dollar's down. Shouldn't gold be up? But I think the bank. That's my theory. I can't prove it, but people say, what's the big deal if we become Japan? Japan's nice place, nice island nation. But when you think about it, Japan's a train wreck. The Bank of Japan is the market for JGBs, Japanese government bonds. Without that, there is no market. They don't trade. And if you look at the Japanese GDP in dollar terms, it is flat going back decades. So not years or not quarters, not months, not years, decades. That particular nation, that island nation, with no natural resources and a currency that's hanging by a thread, their GDP has not increased at all in dollar terms. And then if you look at their stock market, it peaked 35 years ago, and it's still lower in nominal terms than it was 35 years ago. Lower in nominal terms today. So Japan is a disaster nation. It's a zombie nation. And if that's our aspiration, and I think you pointed out that they're ahead of the United States by about a decade. It's very possible that's where we're headed, where the bond market doesn't function because the Fed just takes over our bond market. No one who wants to buy a treasury at the artificially low yields, right? Because every auction is being satisfied by the Federal Reserve. That's what I think where we could be headed, and that just marks stagflation. Stagflation. The yen, I think the yen is down 15% this year against the dollar. And when you import if you're importing all of your goods, and your yen is down 15% against the dollar, a major trading partner, it's down against the euro and it's down against even the yuan. Those are the three major trading partners of Japan. It's a disaster. So I think we should aspire. I think Americans should aspire to have a greater outcome than Japan.
Now let's explore Michael Pento's insights on the potential for disinflation or even deflation in the economy and how this could further impact silver prices. Understanding these economic phenomena is crucial to grasp why silver could see a dramatic price increase. First, let's define the terms. Disinflation refers to a slowdown in the rate of inflation, meaning prices are still rising, but at a slower pace. Deflation, on the other hand, is a decrease in the general price level of goods and services, meaning prices are falling. Both scenarios can have significant implications for the economy and, by extension, for silver prices. Michael Pento has highlighted the risk of another bout of disinflation or even a period of deflation as the economy faces multiple pressures. One of the key drivers of this potential scenario is the enormous amount of debt accumulated by governments, corporations, and consumers. When debt levels are high, the cost of servicing that debt becomes a significant burden, especially if economic growth slows down. In a disinflationary environment, the slowdown in inflation can lead to reduced consumer spending as people anticipate lower prices in the future. This can create a vicious cycle where reduced spending leads to lower economic growth, which in turn leads to further disinflation or even deflation. For investors, this scenario increases the attractiveness of safe haven assets like silver, which can retain value even when the broader economy struggles. Deflation is even more concerning. In a deflationary environment, the value of money increases as prices fall, leading consumers and businesses to delay purchases and investments, expecting lower prices in the future. This can severely hamper economic growth and lead to higher unemployment rates. For central banks, deflation is challenging to combat because traditional monetary policy tools, like lowering interest rates, become less effective once rates are already near zero. In such a scenario, precious metals like silver become highly attractive. During deflation, the value of cash increases, but so does the value of tangible assets like silver, which do not lose purchasing power. Additionally, investors often turn to silver and gold as stores of value to protect against the economic instability that accompanies deflation. Moreover, Pento points out that the Federal Reserve's potential inability to lower interest rates significantly due to already low rates and high inflation could lead to a scenario where economic growth stalls, leading to disinflation or deflation. This is compounded by the fact that the Fed has limited tools left to stimulate the economy without exacerbating inflation. If disinflation or deflation sets in, silver's role as a hedge against economic instability becomes even more pronounced. The industrial demand for silver might take a hit due to reduced economic activity, but this would likely be offset by increased investment demand. Investors seeking to preserve their wealth during times of economic uncertainty would flock to silver, driving up its price. Pento also notes that in the aftermath of potential disinflation or deflation, central banks might resort to even more aggressive monetary policies, including quantitative easing and potentially negative interest rates, to stimulate the economy. These measures would eventually lead back to higher inflation, reinforcing silver's attractiveness as a long-term hedge against both inflation and deflation. In conclusion, Michael Pento's insights on the potential for disinflation or deflation highlight another critical factor supporting a bullish outlook for silver. The economic instability associated with these scenarios makes silver an essential asset for investors looking to protect their wealth. Next, we will synthesize all these factors in our final segment to explain how they collectively set the stage for silver to reach $3,000 by the end of the year.
The U.S. is insolvent too. You look at a quarter of all our revenue now is being spent on interest payments. So it's an insolvent nation, but you have that in common with the Japanese condition. But you also have something that Japanese don't have. It's even worse. Is that we have the world's reserve currency, and we're abusing that status on a regular basis. And one of the things that we're doing to abuse that status is this unilateral hegemony use, where we just say we're confiscating your reserves. And so if you're a nation that has a very high trade surplus, and you recycle that into a capital account surplus. So in other words, you're buying treasuries or you're buying properties, you're buying things that are dollar denominated with your excess savings, your currency reserves. And then capriciously and arbitrarily, the United States says, those reserves aren't yours anymore. They're ours. Well, that scares nations. We've done that before. I'm not saying we're wrong to do it. I'm saying that's what we do. So, and in some cases it might be justified. But here we're talking about finance here, right? We're not talking about morality. We're talking about finances here. So what nations are doing is they are saying, rather than parking my excess, my trade surplus, my excess reserves with you in treasuries or purchasing capital in your nation, what I'll do is I'll just buy gold or I'll buy Bitcoin. And I control it. It's in my purview. And that's how they're getting around any future sanctions or confiscations that could come up in the future. And we just hear, both presidents, right or wrong, this is what they're saying. There are massive trade wars with China brewing here. Tariffs, and that's just one of the reasons. And tariffs aren't confiscating reserves, but they're not the same, but they're cousins. And that's why I think China, Brazil, Venezuela, Russia, just to name a few nations who are just starting to eschew dollars and running to gold.